You have probably lost more money from being unable to sit still than from being unable to read a chart. That is not a pleasant truth, because activity feels responsible. It feels like work. You study the candle, adjust the stop, add to the position, close too early, enter higher, and tell yourself you are managing risk. But very often, you are not managing the trade. You are managing the discomfort of waiting. The market has a way of punishing the trader who needs constant confirmation. It does not move simply because you are watching it closely. It does not reward you for touching every fluctuation. A price can move against you for no meaningful reason, then return. A stock can hesitate before breaking out. A market can drift for hours, not because it is confused, but because it is gathering orders from traders who are. This is where the better trader begins to separate himself. He learns that watching is not laziness. Watching is the work. It is where judgment is formed before money is committed. It is where you learn the difference between a true opportunity and a temptation dressed up as one. The impatient trader sees motion and feels invited. The disciplined trader sees motion and asks what kind of hands are behind it. There is a great difference between watching price and waiting for permission. Watching means studying how the market behaves around important areas. Does price reject a level quickly, or does it linger there? Does volume expand with conviction, or does it appear only after the easy move has already passed? Are traders pressing into strength, or are late buyers being absorbed by quieter sellers? These details matter because the market often reveals intention before it reveals direction. Not always clearly. Not always in a way that can be reduced to a simple rule, but enough that the trader who observes patiently begins to notice character. He sees when a move is strong but vulnerable. He sees when weakness is not yet real weakness. He sees when a breakout is obvious enough to attract the crowd, and therefore dangerous enough to question. The mistake is believing that every observation requires a trade. It does not. In fact, the purpose of most observation is to eliminate trades. Each minute you spend watching without acting should narrow the field. You are not looking for something to do. You are looking for a reason not to do anything until the reason for action becomes strong enough. This changes the trader's relationship with the market. Instead of asking, "Where can I enter?" he begins asking, "What would prove this idea wrong? Who is likely trapped here? Where would forced buying or forced selling appear? Is this move being supported or merely chased?" Those questions slow the hand, and a slower hand in speculation is often the beginning of better judgment. The best traders may spend only a small portion of their time entering, exiting, or adjusting positions, but that does not mean they are inactive. They are reading pressure. They are watching failed attempts. They are studying how price behaves when it should move and does not. Because when a market refuses to do what the crowd expects, it is often saying something more important than a candle pattern ever could. And that is where we begin, not with the trade itself, but with the long silence before it, the part most traders rush through, and the part that may decide everything that follows. The most expensive trade you take is often the one that begins with a feeling you do not want to admit. Not a signal, not a clean opportunity, not a clear reading of the tape, just a small pressure inside you that says, "Do something." The market has not offered enough evidence, but your mind has already begun to search for a reason. A candle becomes important because you need it to be important. A minor pullback becomes a setup because you are tired of waiting. A small move against your earlier idea becomes personal because you feel the market is leaving without you. This is where many traders misunderstand themselves. They think they are analyzing the market when they are really negotiating with discomfort. Waiting feels empty. Watching without acting feels like falling behind. So the trader begins to confuse presence with participation. He thinks that because he is at the screen, he should be involved. But the market does not pay a man for being present. It only pays when his judgment is better than his impulse. The need for action has many disguises. Sometimes it appears as confidence. You tell yourself you can read the move early. Sometimes it appears as discipline. You say you are following your plan when the plan has been quietly bent to fit your impatience. Sometimes it appears as courage. You convince yourself that hesitation is weakness. But very often, the urge to trade is not strength at all. It is the mind trying to escape uncertainty. Uncertainty is difficult because it gives you nothing to control. When you are in a trade, at least you have something to manage. You can move a stop, watch profit and loss, adjust your opinion, feel engaged. But when you are only watching, you are left alone with your own restraint. That is why watching is harder than it looks. It removes the illusion of control and asks whether you can remain steady without being rewarded immediately. The danger is not merely that you take one unnecessary trade. The danger is what that trade does to your state of mind. Once you act from restlessness, you create a new problem. Now you must defend a position that was not born from clarity. If it moves against you, pride enters. If it moves for you, carelessness enters. Either way, the first error multiplies because the trade was not based on calm judgment. It was based on relief. A trader who cannot sit still becomes easy for the market to move. A fast push upward makes him afraid of missing out. A sharp dip makes him feel there is a bargain. A quiet hour makes him impatient. A losing morning makes him eager to recover. None of these reactions are unusual. They are human. But the market has no mercy for what is merely human. It exposes the habit, repeats the pressure, and waits for the trader to mistake emotion for opportunity. So the first work is not to predict better. It is to notice the moment when your attention changes. Are you watching price, or are you looking for permission to act? Are you calm enough to let the market pass without you, or do you feel insulted when it moves and you are not in it? Do you feel a trade forming from evidence, or from the fear that doing nothing means wasting time? This is why the best traders spend so much time watching. They are not only watching the market, they are watching themselves in the presence of the market. They learn the difference between genuine alertness and emotional hunger. Alertness is quiet. It can wait. Hunger is noisy. It wants the next candle to solve the discomfort of the last one. When you understand this, the screen becomes a mirror. Each moment without a trade teaches you something about your own tolerance for uncertainty. Each missed move tests whether you respect your process or worship activity. Each quiet session asks whether you came to trade well or merely to trade, and once that distinction becomes clear, the next question becomes unavoidable. When action finally is justified, how should it be taken? When action finally comes, it should not feel like a surprise. The weaker trader enters because the market suddenly catches his attention. The stronger trader enters because the market has arrived at a place he has already studied. That difference may appear small from the outside. Both men click the same button. Both may buy at nearly the same price. But one is reacting to movement, while the other is completing a decision that was prepared before the movement began. Good execution begins long before the order is placed. It begins when you know the level that matters, the condition that would make the trade valid, and the point where the idea is no longer worth defending. Without that preparation, the entry becomes emotional even if the chart looks reasonable. You are forced to decide too much at the moment of pressure. And when pressure is high, judgment narrows. This is why watching is part of execution, not separate from it. As price approaches an area of interest, you are not merely staring at candles. You are preparing the terms of the trade. Where would the entry make sense? Where would you be wrong? Is the distance between those 2 points acceptable? Is the market moving in a way that gives you enough time to act cleanly, or is it already stretched beyond a sensible entry? A trade that cannot be defined before entry often becomes difficult after entry. If you do not know why you entered, you will not know whether to hold. If you do not know where the idea fails, every small move against you will feel like a judgment call. If you enter too late because you were not prepared, you may have to use a wider stop than the trade deserves. One weak decision forces another, and soon the position is no longer managed by a plan, but by adjustment. The best traders watch because they want the order itself to be simple. They do not want to be calculating everything while the market is moving fast. They have already considered the level. They have already considered the risk. They have already considered what must happen before they act. So when the moment arrives, execution is not rushed. It is precise because the uncertainty has been reduced in advance. This does not mean the market must be perfectly clear. It never is. Execution is not the search for certainty. It is the practice of acting only when the conditions are clear enough to justify risk. There is a great difference between entering because something is moving and entering because the market has met your requirements. One puts you at the mercy of speed. The other keeps you tied to structure. You should know, before you enter, what you are paying for. Are you paying for early positioning? Then you must accept that confirmation may be incomplete. Are you paying for confirmation? Then you must accept that the price may be less favorable. Are you entering on a pullback? Then you must know what kind of failure would make that pullback dangerous. Every entry has a cost. Watching helps you understand that cost before you accept it. This is where execution becomes quiet. The trader is no longer asking, "Should I jump in?" He is asking, "Has the market done what I required?" That question protects him from many unnecessary decisions. It also keeps him from turning every movement into a personal debate. The trade either qualifies or it does not. When you watch properly, the entry is earned. It is not taken because you are tired of waiting. It is not taken because the move looks exciting. It is taken because price, risk, timing, and invalidation have come together closely enough to make action reasonable. And once you begin to see execution this way, another truth starts to appear. The real improvement may not come from taking better trades only, but from understanding how many trades should never be taken at all. A trader can be right often and still lose money. That fact unsettles people, because it goes against the way the mind wants trading to work. The beginner thinks profit comes from finding more winning trades, but the account does not measure how often you feel correct. It measures the size of your wins, the size of your losses, the cost of each attempt, and the quality of the opportunities you choose to accept. This is why watching has a mathematical value. It is not only a matter of patience or skillful timing. It is a way of protecting expectancy. Every trade you take enters the arithmetic of your results. A small loss is not just a small loss. It is a deduction from the edge you are trying to preserve. A careless break, even trade, is not harmless if it consumes attention, adds fees, creates slippage, and lowers the standard of what you call opportunity. The market gives a trader many chances to act, but very few chances that deserve capital. That difference is where the mathematics begins. If you take every decent-looking setup, your average quality falls. When average quality falls, your edge becomes thinner. When the edge becomes thinner, normal losses begin to feel abnormal, because there is not enough advantage in the system to absorb them. A good trader understands that selectivity is not about being timid. It is about refusing to dilute the best trades with ordinary ones. 10 trades may produce activity, but only 2 may carry the right relationship between risk and reward. If the other 8 are weak, they do not merely stand apart from the good trades. They pull the whole record down. They increase the number of decisions required, raise total transaction costs, and expose the account to randomness that should never have been invited. This is why fewer trades can lead to better results. Not because less is always better, but because lower quality trades have a hidden drag. They may lose outright. They may win too little. They may require a stop that is too wide for the possible reward. They may enter where the distance to the target no longer justifies the risk. They may look acceptable in isolation, yet damage the larger arithmetic of the month. A trader who watches carefully begins to see trades in terms of contribution. What does this trade add to the expectancy of the whole operation? Does it improve the average, or does it merely increase the count? A trade that has no clear advantage is not neutral. Once capital is committed, it has weight. It can produce loss, cost, distraction, and opportunity cost. The account pays for every unnecessary attempt, whether the trader respects that fact or not. The important point is that expectancy is built before the trade is taken. It is built in selection. A trader may manage a position well after entry, but if the setup was mathematically poor from the start, management can only do so much. You cannot turn a weak proposition into a strong one by watching it nervously. The better work is done earlier when you decide whether the trade deserves to be counted at all. So the best traders spend long periods watching because they are sorting opportunity from noise by its effect on the whole record. They are not asking, can this trade win? Almost any trade can win. They are asking, is this the kind of trade that should be repeated over time? That is a different question. It removes the fascination with one outcome and places attention on the series. This is where the amateur often misjudges the game. He remembers the trade he skipped that would have worked. He forgets the many weak trades he took that slowly reduced his account. The professional thinks differently. He knows a missed winner is not the same as a bad decision. If the trade did not meet the standard, passing on it protects the system. The purpose is not to catch every movement. The purpose is to take only the trades that improve the long-term equation. Once you see trading this way, watching becomes an act of arithmetic discipline. Each rejected trade preserves capital for a better condition. Each avoided cost keeps the edge cleaner. Each moment of non-action helps prevent the account from being filled with low-grade risk. But numbers alone cannot tell the whole story, because the market is not a clean table of probabilities. Those probabilities are formed inside living movement, pressure, and behavior. And that is where the next layer begins. Price often speaks before direction becomes obvious. Not in a clean sentence, not in a way that removes risk, but in small acts of behavior that reveal pressure. A level is tested and rejected. A breakout appears strong, then cannot hold. A decline looks heavy, yet sellers fail to push it lower. The surface of the chart shows movement, but beneath that movement there is a contest between commitment and hesitation. This is why the best traders watch. They are not waiting for the market to announce itself plainly. They are studying how it behaves when it reaches places where decisions are likely to be made. A level only matters if traders respond to it. A range only matters if attempts to leave it are accepted or rejected. A candle only matters in relation to what came before it, where it formed, and what happened after it. The inexperienced eye sees price rise and thinks strength. It sees price fall and thinks weakness. But the market is often more subtle than that. Strength that cannot continue may be distribution. Weakness that cannot break may be absorption. A fast move into a level may look impressive, yet if it is immediately sold into, the move has revealed something different from what it first suggested. The question is not only, did price move? The better question is, how did the market respond when price moved? Watching allows you to see effort against result. If buyers push with force but gain little ground, something is resisting them. If sellers attack repeatedly but the low holds, demand may be present even while the chart looks weak. If volume expands and price barely advances, the market may be accepting heavy supply. If volume expands and price moves cleanly through a level, the pressure may be genuine. The meaning is not in volume alone or price alone. It is in their relationship. This matters because market structure is built from failed attempts as much as successful ones. A failed breakout can trap late buyers. A failed breakdown can trap late sellers. When those traders realize they are wrong, their exits can fuel the opposite move. The trader who has been watching understands where that pressure may come from. He is not surprised when a market reverses after appearing obvious. He has seen the crowd lean too far in one direction and fail to get paid. The same is true around important highs, lows, ranges, and prior turning points. These areas attract attention because they contain memory. Traders who bought earlier may want to defend. Traders who missed the first move may want a second chance. Traders holding losses may look for an exit. New traders may see the level as confirmation. When price returns there, it is not returning to an empty place. It is returning to unfinished business. You should watch how long price stays near such areas. A quick rejection can show refusal. A slow grind can show acceptance. A sharp break followed by immediate return can show a trap. A repeated test with smaller reactions can show that one side is losing its force. None of these observations gives certainty, but each one gives context. And context changes the meaning of the next move. This is where watching becomes practical. You begin to separate clean movement from vulnerable movement. You notice when a market should continue but stalls. You notice when it should break but holds. You notice when a move becomes too obvious and begins attracting the wrong kind of participation. The best opportunities often appear after the market has tested belief and exposed who was too early, too late, or too confident. A trader who does not watch this behavior must trade the chart as a flat picture. He sees lines, candles, and patterns, but misses the pressure behind them. The trader who watches long enough begins to read the market as a sequence of decisions. One side tries, the other side responds. Price either accepts the attempt or refuses it. From that exchange, character begins to appear. And once you begin to read character, the next question is no longer whether the market is moving, but whether the evidence is strong enough to deserve a decision. A poor trader looks for a reason to say yes. A better trader spends most of his time looking for a clean reason to say no. That may sound backward, because trading appears to reward the person who finds opportunity. But the market offers endless reasons to be interested. Interest is cheap. A decision must be earned. If you cannot reject most of what you see, then every chart, every movement, and every slight improvement in price begins to compete for your capital. Watching gives the trader distance from the first impression. The first impression is often too generous. A setup looks promising because one part of it is attractive. A level looks useful because price has reacted there before. A move looks tradable because it has energy. But a decision cannot be built from one piece of evidence. When you watch longer, weak points begin to appear. The idea may still be interesting, but it may not be complete. This is the quiet value of saying no early. It clears the mind. Each rejected idea removes a demand on your attention. If a trade needs too many explanations to remain valid, it is not a clear decision. If the reason for taking it keeps changing as new candles form, the trade is not maturing, it is being defended before it even exists. A clean no prevents the trader from becoming attached to an unclear yes. The best traders do not watch because they are indecisive. They watch because they know that good decisions require separation. You must separate evidence from noise, condition from opinion, and possibility from probability. A market can offer a possible trade almost every few minutes, but possibility alone has no discipline. It only says something could happen. A tradable decision asks whether enough has happened to justify acting. There is a danger in treating every uncertain situation as if it only needs more courage. Some uncertainty is natural. No trader escapes it. But some uncertainty comes from poor selection. The chart is mixed. The timing is unclear. The risk is awkward. The supporting evidence is thin. When those conditions are present, hesitation may not be fear. It may be intelligence. The mind is warning you that the decision has not been formed. Watching helps you identify the kind of uncertainty you are dealing with. If the trade idea becomes clearer as time passes, observation is working. If it becomes more complicated, that is information too. A sound idea usually does not need constant repair. It may need patience, but it should not need invention. When each new piece of data forces you to redraw the argument, the market is not confirming the decision. It is exposing its weakness. This is why a strong no can be more valuable than a weak yes. A weak yes creates obligation. Once you lean toward the trade, you begin to collect supporting evidence and ignore what does not fit. But a strong no keeps you free. It allows the market to continue without making you responsible for every movement. It gives you the right to wait for a cleaner condition without carrying the burden of a half-formed idea. You should train yourself to ask, what would make this unworthy of action? That question is different from asking what could go right. It forces the trade to prove itself. Is the idea dependent on one candle? Is the situation too unclear? Has the best part of the move already happened? Are you choosing between two conflicting stories because neither one is strong enough? These questions do not create fear. They create order. A decision becomes stronger when the unnecessary choices have been removed. The trader is no longer standing in front of 10 possible trades with equal attention. He has narrowed the field. He has allowed several ideas to fail without regret. By the time one idea remains, the decision has weight because it has survived rejection. This is how watching turns into judgment. not by collecting endless information, but by removing what does not deserve action. The trader who can say no cleanly is not missing the market. He is protecting the quality of his next yes, but that kind of watching cannot be casual. If observation is going to sharpen decisions instead of merely consume time, it needs structure, routine, and professional order. Watching is only valuable when the trader knows what he is watching for. A screen can keep a man busy all day and teach him very little. Prices flash, candles form, alerts sound, and the mind feels occupied. But occupation is not preparation. The professional trader does not begin the session by asking the market to entertain him. He begins with order. He reduces the field before the opening bell ever tests his judgment. This is one of the quiet differences between a serious trader and a casual one. The casual trader arrives at the screen and starts searching. The serious trader arrives with a map. He already knows the names worth attention, the levels that matter, the conditions that would make those levels important, and the broader context around the market. His watching has direction because his preparation gave it direction. A watch list is not a list of symbols that might move. It is a list of responsibilities. Each name on it should have a reason to be there. Maybe it is near an important level. Maybe it has unusual volume. Maybe it is reacting to news. Maybe it belongs to a sector showing strength or weakness. Without a reason, the symbol becomes noise, and too much noise makes the trader slow when he should be clear. The same is true of levels. A line on a chart means little unless the trader knows why it matters. Prior highs, prior lows, consolidation areas, gaps, failed moves, and zones of repeated reaction all carry different meaning. The professional marks them in advance because he does not want to discover importance after price has already arrived there. Preparation allows him to watch the reaction instead of scrambling to understand the location. Context also has to be prepared. A stock may look strong by itself, but if the market is heavy and its sector is weakening, that strength has a different character. Another name may look quiet, yet if its group is being accumulated, that quietness may deserve attention. The trader who watches only one chart often misreads what he sees. The trader who understands the surrounding conditions gives each movement a more accurate place in the larger picture. This is why the opening minutes are not a command to act. They are a test of preparation. Price begins to move, spreads change, volume appears, and the market shows which ideas are alive and which ones were only interesting before the session began. The professional watches to confirm relevance. He is not trying to chase every early burst. He is checking whether the market respects the areas he prepared. A proper routine also protects the trader from relying on memory. Memory is too flexible during live markets. What seemed obvious before the session can become vague once price starts moving. So the serious trader writes things down. He notes the key level, the intended condition, the reason for watching, and the reason to ignore the trade if the situation changes. This is not paperwork. It is a way of keeping the live market from rewriting the plan. During the session, his notes become a record of behavior. Which names held their levels? Which ones failed to attract follow-through? Which sectors led early and then faded? Which stocks were active but disorderly? These observations may not demand a trade, but they sharpen the trader's sense of what the day is becoming. Without notes, the session becomes a blur. With notes, it becomes evidence. The professional habit is not to watch more charts. It is to watch fewer things with greater purpose. Too many traders confuse access with advantage. They believe that because they can see thousands of symbols, they should scan constantly. But constant scanning often weakens attention. The better habit is to narrow the field. Define the reason, observe the reaction, and keep the process clean. This is how watching becomes work. It has a beginning before the market opens. It has a structure while the market is moving. It has a record after the session ends. The trader is not waiting in a loose and hopeful way. He is conducting a disciplined review of prepared possibilities. And when one of those prepared possibilities finally becomes a live position, the work of watching changes form rather than ending. The trade does not become less dangerous after you enter it. In some ways, it becomes more revealing. Before entry, the idea was clean because it lived in your mind. After entry, the market begins to test it in real time. Price either behaves in a way that supports the reason for the trade, or it begins to show that the reason is weakening. The position now has to earn the right to remain open. This is where many traders stop observing properly. They enter, and then their attention narrows to profit and loss. A green number feels like confirmation. A red number feels like warning. But profit and loss alone can mislead you. A trade can be slightly negative while still behaving correctly. It can be profitable while showing poor character. The question is not only whether the position is up or down. The question is whether the market is doing what it should be doing after your entry. A good trade has expected behavior. It may not move immediately, and it may not move smoothly, but it should begin to show signs that the original idea is still alive. If you bought strength, does price continue to hold firm when tested? If you entered after a pullback, does the market begin to reject lower prices? If you expected momentum, does participation continue, or does the move begin to lose force? Watching after entry keeps the trader tied to evidence instead of emotion.